Okay, I guess we'll go ahead and get started. I have Annalena and myself, Leslie, with the New Mexico Small Business Development Center, and we're very pleased to present webinars of really valuable, relevant information. Today, we have Mr. Larry Donahue, who is an attorney here in New Mexico. And we also have Ian Alden, who is also an attorney here in New Mexico, giving us this information. So I'm going to pop off. If anybody has any questions, please load them into the Q&A, and we'll make sure that we get some resources or answers for you. So thank you. Enjoy the webinar.
Thank you, Leslie, and thank you to the Mexico SBDC for letting us do this. My name is Larry Donahue. I'm an attorney with Law for Small Business, and Ian is another attorney. He's our tax lawyer with Law for Small Business. And we're going to spend, do you mind hitting the next page there? Maybe go another one there. So we're going to talk about PPP and some tax issues for the hour. And, you know, I've been a lawyer a long time, and I know I can bore the heck out of people. So do not be afraid to ask questions in the middle of things, and we will do our best to answer questions. And if we can't answer something, we'll, you know, tell you and see if we can research it and get back to you at a later date to give you the answer you need if it's possible. But in the slide here, just to remind you, please mute your audio and zoom the ratio to fit window if you can, so you don't lose important detail in the presentation. And we will also have Q&A at the end of our discussion, so you'll have time to ask questions then if you don't ask them during the presentation. And by the way, the presentation will be available after this talk, so if you want to be able to reference that, it will be available to you. Any rate, next slide, Ian. So PPP loans and the employee retention tax credit. That's the discussion for today. And we're going to go into quite a bit of detail with both. We also want to remind you that the New Mexico SBDC has a lot of great information on its website. We have the link up there. They have not just counseling and information resources, but they have ongoing training and seminars like this. So I would encourage everybody to go to NMS or nmsbdc.org to see what the schedule is and sign up. We as well, we're in talks with them. It looks like we're going to be doing more of these, and we're going to do different twists on this. Like one presentation will dive down into what seasonal employees are all about, or we might dive into tax issues or contracts. We're going to work with the NMSBDC to figure out what's best for these presentations, but expect those over the next few weeks and next few months. Next slide, Ian. So let's talk about PPP loans first. And we're going to split this up into two sections, and I'll try and prattle on and not bore you too much for the next approximately 20 minutes, and then hand it on over to Ian, who will talk about the employee retention tax credit. Next slide. So with the PPP information, I think it's important to understand where we came from and where we're at and how do we get here kind of thing. So I want to talk about the legislation briefly, and this summarizes it. I'm not going to read absolutely everything from the slide. I think that's boring, but it's worth noting. First, the CARES Act came out in March 2020. It established the initial PPP, and it delivered a staggering amount of money to almost 5.2 million businesses out there. They attribute 51 million jobs to that money. In April 2020, just a month later, they enhanced it by adding more funding. And June 2020, they went even further and did a few things to it that made it easier to use as well as be forgiven. Finally, we had in December 27th of last year, they had a Consolidated Appropriations Act, a 3,000-page piece of legislation that's just outrageous. And buried within it, they have this thing called the Economic Aid to Hard-Hit Small Businesses, Nonprofits, and Venues Act. Let's just abbreviate it to the Economic Aid Act. What they did there is some really interesting things. One is they added more money to PPP, and they also provided the ability to do a second draw for some businesses that had received funds in 2020. Finally, on January 6th, there was a new SBA interim final rule that did a number of things. And one is consolidated 23 previous interim rules and sort of guides where the SBA is going to providing the new funds for 2021. Did we have any? Okay, good. Let's see, our partnerships. And we do have one question. Let's see, they say our partnerships, our LLCs and active participating partners operate out of commercial real estate businesses. We receive K1s with income in box 2 net rental. Are we able to apply for PPPs as individuals? So I'm going to answer Sally's question a little bit later. Give me a couple of slides in and we'll see if we can come up with an answer for her. Ian, do you mind hitting the next slide? So let's review the existing PPP before it's been modified with the new act in December 27th. And just as a quick reminder, the old PPP in 2020, all small businesses were eligible if they were operating prior to February 15th, 2019. Very good terms, 1% interest. You know, it had a 2-year maturity if you had borrowed prior to June 5th, and it switched to a 5-year maturity after a maturity, not maternity, after June 5th, no fees, no collateral, no personal guarantees. It first covered 8 weeks of expenses, and then it increased to 24 weeks and allowed you to kind of pick whether you wanted to look at a 24-week window or an 8-week window. You were originally required to cover 75% of your payroll, and then it lowered that to 60%. And then it had other eligible expenses for the other portion of that. There was always a cap for higher salaried individuals at $100,000. And what that means is if you had a $110,000 employee, you could look at the $100,000 of that employee, but not the additional $10,000 above the original $100K. Can you hit the next slide, Ian? So what are the key changes for 2021? There's a few. First is the small businesses are a little bit more restricted. You have to have 300 or less employees. The operating time frame was February 15th of 2020. Public companies are not permitted to participate, but they did expand a little bit by allowing 501c6 companies. Also certain cooperatives, marketing organizations, a few other organizations that Congress felt should probably be able to participate in the PPP. Still, we have the same 1% interest rate, 5-year length. But what you do need to know is the covered period. It used to be 8 weeks or 24 weeks. You had to pick. Now it is defined by the business within the 8 to 24 week window. And so that is going to give you some flexibility depending on whether you had some employees come or go and trying to figure out how to maximize your ability to forgive some of that loan information. There's greater flexibility for seasonal employees, and we're going to talk a little bit more about the second draw and the PPP forgiveness. They also did a streamlined forgiveness form if your original PPP loan was under $150,000. It's a one-page certificate or certification that I looked at it and looked pretty darn simple. You're pretty much just making some affirmations of how you spent the money and what your staffing numbers were. There is another question that came in. I started my business in 2019, but had no revenue. Does that mean I won't qualify for second round since I did have income for the same time, same quarter, year over year? So Travis typed in a question basically asking about would he qualify for PPP when he didn't have any revenue in 2019? And, you know, that's a good question. And it's hard for me to tell you yes or no on that. What I would recommend, Travis, is you talk to a CPA that can help you look at your books and what has happened, and you still may qualify. There isn't, if you're talking about second draw funds, that might be a little harder, because if you weren't making any money last time and now you are, in theory, you you probably don't meet the financial requirements, but we'll talk about that more. And let me talk about the next slide and see if that helps answer your question. Can you go to the next slide there, Ian? Thank you. So let's talk about eligible expenses. Did we go one too far, Ian? Did we skip a slide? No, okay, I apologize. So we're good. So let's talk about the eligible expenses for PPP. And this is part of the changes for 2021. 60% of the PPP funds must be spent on payroll and 40% on eligible expenses. And what's really interesting about 2021 is the bullets, the fourth bullet onward. So the first three bullets, mortgage interest payments, rent and lease payments, utilities, those were covered in 2020 with the older PPP statutes and language, but they've expanded it now to include like software and accounting needs and expenditures. What's really important here is COGS for supplier costs. That was not part of the eligible expenses for 2020. They've also expanded the group insurance payments, property damage for public disturbances not covered by insurance, and PPE expenses for certain businesses. So those will be covered under that 40%. Next slide, Ian. And let's talk about that second draw. So the second draw is for businesses who had received PPP funding in 2020. I mentioned 30 employees or less. You have to be operating February 15th at least in 2020. You had to have used all the PPP funds and for authorized uses only. So if you bought yourself a Lamborghini or something with the PPP funds last year, you're not going to qualify. The other thing is you have to demonstrate, and this is the big one, this is the big issue, and I'm not sure if this is going to hit on Travis's question, but you have to demonstrate a reduction in gross receipts. Now that's what's in the statute, and for us New Mexicans, we get confused when we hear gross receipts. We're not talking about gross receipts taxes, we're talking about gross revenues. So if you've had a reduction in gross revenues in comparable quarters between 2019 and 2020, then you'd qualify for a second draw. So if you've started in 2020, February 2020, and you don't have any income in 2019, or you started in 2019 with no income, but you've grown income since then, you're probably not going to qualify for a second draw, but you can certainly qualify for a first draw if you hadn't done that already. Now, there are some issues with the loan amounts that are available for you. The first one is there's a maximum cap of $2 million. The next one is you have to look at the total monthly payroll costs, and that's an average in 2019, and then you multiply it by 2.5 for most businesses, and you get to multiply it by 3.5 if you're in certain accommodation and food service businesses, the NAICS 72 type category businesses. And then the full forgiveness terms, it's the same terms basically right now for the first draw regarding employee and compensation levels. And what I mean by that is don't forget the salary caps, and you can have issues where employee levels might fluctuate and maybe you've gone down, but you want to pick the right the right period between that 8 and 24 weeks to maximize your forgiveness opportunity. Next slide, Ian. So payroll costs. There's also some changes as it relates to what payroll costs are covered in the PPP loans. It's the standard W-2 type salary, wages, tips, commissions with the cap, that $100,000 cap you have to remember. Employee benefits are also covered. So vacation, parental, family, medical, sick leave, and group health care benefits are covered. Retirement benefits, state and local taxes paid on compensation. But you are also, if you are a sole proprietor or independent contractor, wages and commissions incomes paid to those are also available as part of the payroll cost calculation for PPP. But remember, you still have that $100,000 annualized cap. What's not covered is payments made to independent contractors. It's not part of the payroll calculation costs, unfortunately. And that means also if you're an owner of a company, S Corp or C Corp, tax status. So it can be an LLC taxed as an S Corp or C Corp as well. And if you're not on the payroll, you don't count that money that might go to you. That includes the shareholder distributions. And so let's get back to Sally's question. She asks, are partnerships, our LLCs and actively participating partners operate our commercial real estate business? We receive K-1s with income in box 2 net rental real estate earnings, not box 14 self-employment income. Are we able to apply for PPP as individuals? Is there any relief in this situation for either members or the businesses themselves? Ian, do you know what is in box 2 net rental earnings versus box 14 self-employment income? Do you know those off the top of your head?
Well, let's see here. It's just different characterizations of income. You've got your net rental real estate earnings, which is a passive income type, and then the other is self-employment income, akin to what you might otherwise see on a Schedule C. I know the differences between the incomes. I just don't know how they impact PPP eligibility. That's something that we'd probably have to look into.
Yeah, I'm sorry, Sally. We're going to struggle on giving you an exact answer right now. But if you want to send us your email address in the chat, we will look that up and send you an answer back if you don't mind. Ian, can you hit the next slide? So let's talk about forgiveness briefly. And I'm a former engineer, and I like to think in terms of math. And this is not the formula you're going to find in the statute. This is a formula that I came up with just to help me better visualize how forgiveness works. And so I want to briefly chat about it. You don't need to write this all down. You can look at it in the materials that you can get from us afterwards. But the question is let's just pretend you had $100,000 of PPP loans. The question is, how much of that is forgivable? So A represents the amount possible to forgive. And remember that if you had 2 employees at $200,000 each, you have those $100,000 caps. So you almost have to pull the $100,000 additional monies from their pay from the amount forgivable. So you kind of have to look at that unless you're able to show that you have other expenses that would fall within the other categories of approved or eligible payments. So A is the amount possible to forgive, and then you multiply that by a quotient, which relates to the full-time equivalents, the average full-time equivalent employees you have during the covered period. And then after that, you subtract any salary and wage reductions that might have occurred, again, within the covered period. So the covered period is really critical if you have issues with employees coming and going. And that covered period is defined by you between 8 weeks and 24 weeks. And the 8 weeks or 24 weeks, or whatever time you elect, starts when the funding was provided to you. And we have another question here from Hillary. I'd like to apply for a loan. I just started my LLC in January 2020, and I don't have any official employees. Can I still apply for the loan? And then they're not forgivable because I don't have any employees, or is the loan only for businesses with employees? Well, that's a good one, Hillary. I'm going to assume you are the sole owner of that LLC, and if it's disregarded for tax purposes, then you could possibly apply as a sole proprietorship. And you would be able to apply for the PPP funds as a sole proprietorship, even though an LLC is technically your company. So if it gets more complicated than that, then you're probably going to need to talk to a CPA to figure out whether you would apply or not, and if so, how you would do that. So let me go back to my questions here. So what is the quotient, the FTE reduction quotient? Think of it as X over Y, where X is the average number of full-time equivalent employees you had during the covered period when you had the money. The Y number, which is below the X number, is the average number of full-time equivalent employees during the previous time period in 2019. So if you had the first draw, we are waiting for some additional clarification with the SBA, by the way, on whether you'd apply the same time period for the covered period you picked in 2021 versus the time period that was utilized for the first draw. We're still trying to figure that out. But if you think about X over Y, if X is smaller than Y, meaning you have less employees now during the covered period than you did last year, you're going to have a fraction that is less than 1, which means it's going to reduce the amount of available to forgive by that fraction. So it's going to have a big impact is the point here. But I do want to tell you that the SBA does have some loan forgiveness applications and calculation forms out there. So you might want to take a look at those if you do not have a CPA or somebody you can talk to help figure out what would be the best way to slice and dice the covered period to maximize the forgiveness amount. Ian, can you hit the next slide? So my last slide here before I hand you on to Ian is how to apply for PPP funding. Don't go to the SBA directly, by the way. You want to work through your bank. You got to contact your lender and complete the forms as requested. Now, here's the issue that I'm seeing a lot of businesses run into. Their existing banks are not being very forthcoming. They're not being very responsive, and that's a problem. But you have to remember the banks are getting overwhelmed by the requests. So what you want to do is make sure you get in the queue properly so that somebody's going to make sure that your information gets put in the underwriting process. So that's the big issue. If you're waiting for your banks to answer your questions, just so you know how to submit the applications, you're going to get yourself into trouble. What you want to do then in that case is talk to a CPA or accountant that can help you. And what you want to do is complete all the applications and get them into your bank so that you can get in the queue for underwriting. That's what's really important. And hopefully somebody from your bank will get back to you to help you finalize your documentation and compile it as necessary. Now, if you can't find, your existing bank isn't helping you, you need to see if maybe there's another bank out there that's willing to help. And I'll tell you, we had that issue, our law firm, and we have trust accounts that have close to $1 million in them. And our bank at the time wouldn't even return our phone calls. So we ended up going to another bank that helped us. But we were very lucky. A lot of banks are only willing to help their existing clients, not their new clients. So you really need to, shake the bushes out there and see if you can find a bank that's willing to help you. And then finally, you have to work closely and carefully with your lender throughout the process, including the forgiveness process. Next slide, Ian. This is you.
All righty. Thanks, Larry. So I'm going to be talking about the employee retention tax credit. It's another relief mechanism Congress passed alongside the PPP loans. At the offset, they made them mutually exclusive, which is why a lot of people haven't heard of the employee retention tax credit or haven't looked into it extensively or made use of it. because at the offset, they were mutually exclusive. You had to pick one or you had to pick the other. And of the two, the PPP loans proved by leaps and bounds to be the more effective relief mechanism. It got money into people's hands immediately, and it wasn't, yeah, despite all of the bureaucracy and hurdles to getting a PPP loan, it proved to just be a more effective, immediate source of funding for businesses that let them cover more in overhead than the ERTC. But because of recent changes to the ERTC, in which I'll talk about shortly, it's no longer necessarily mutually exclusive. And so now it's warranting a second look. People are looking to it and saying, can I get a little more relief out of this? So some basics here. The ERTC, it's a tax credit. It's an advanced tax credit, kind of like the Affordable Care Act premium subsidies. It's a tax credit that you're eligible for, that you're determining your eligibility for in this year, that you then you can either claim next year or you can claim in advance this year. And I'll talk about the mechanism in a little bit. I'll also get to Q&As at the end of this session because I'm sharing the slides. It's actually very difficult for me to go back and forth into the Q&A. So send in your questions as you have them and I'll answer them all at the end. But as the slide suggests, the ERTC, it's a tax credit of up to 50% of up to $10,000 in qualified wages paid by an employer whose business has been financially impacted by COVID-19. It's available to you regardless of the size of your business, the number of employees. It doesn't discriminate based on the size like the PPP loan has been known to do or not do. The definition of qualified wages, however, does differ depending on the number of employees you have. I made these slides with the assumption that I'm not dealing with many employers, if any, who have more than 100 employees. So if you fall into that latter category, feel free to reach out. I'm more than happy to chat about your situation. But the original scope of this tax credit was between March 2020 and the end of 2020. The latest COVID relief bill that was passed in December actually extended it through June 30th, 2021, and boosted the amounts for the first 2 quarters of this year, which we'll talk about as well. But looking at eligibility for the tax credit, you can be a private sector business, a tax exempt organization, 501c3. Eligibility is dependent on how COVID-19 impacted you. If a public health order directly caused your shutdown, if, for example, your business fell into a category that was deemed high risk or non-essential, for example, and you were forced to shut down for some period of time, that created the significant hardship, which allows you to claim the ERTC. If you experience a significant decline in gross receipts during the calendar quarter, that creates your eligibility as well. We'll talk about what significant decline means in the next slide, but there's more than one way to become eligible for the ERTC. Now, significant decline, and it's important to understand the goalposts for this tax credit because you can claim it in multiple quarters and they stack. So, it's 50% of up to 100,000 or 50% of up to 10,000 eligible wages per quarter. So you can claim this in multiple quarters depending on how long your significant decline or hardship lasted. So it begins on the first day of the first calendar quarter in which your gross receipts are less than 50% of the gross receipts for the same calendar quarter in 2019. So it is a look back process, which doesn't favor businesses that started this year in the pandemic, obviously. It's a look back to what your business was making in 2019 and then measuring year over year if your receipts had declined. But what's interesting about when it ends is that the hardship period where you're eligible for the ERTC ends on the first day of the calendar quarter after your gross receipts have recovered. So if your gross receipts recover in Q3, of 2020, for example, you're still eligible to claim that tax credit for Q3. You just lose eligibility going forward. So you kind of get a recovery quarter there. It's important to understand that gross receipts does not have the same meaning as it does in our New Mexico Gross Receipts Tax and Compensating Tax Act. It's not the same as the gross receipts less exemptions for our gross receipts tax. It really is just looking at your gross business revenue. Now, qualified wages, because the amount of the tax credit you can claim is based on qualified wages. So it's 50% of up to $10,000 in qualified wages per employee per quarter. Now, what's interesting about qualified wages is that it includes your standard wages, benefits, compensation, anything that's typically considered wages in the Internal Revenue Code, but it also includes allocable healthcare costs, even if no other wages are paid, which means if you furloughed your employees but kept paying their healthcare costs, their health insurance premiums, or subsidizing them, that counts as qualified wages for the employee retention tax credit. So you could potentially get up to 50% of that back in the form of a tax credit per each quarter. That's an interesting benefit for people who are at least covering the healthcare costs of their furloughed employees. Now, one of the most confusing parts of this tax credit is simply how to claim it, especially because, as I mentioned, up until late December, it was assumed that these relief mechanisms were mutually exclusive, meaning if you took a PPP loan, you couldn't take an employee retention tax credit. That changed, obviously, and so people are now asking, can I retroactively claim this credit? And the answer is, by and large, yes. But you might need to go back and do some amendments to your previous filings. There are actually 2 or 3 lines on Form 941, that's the quarterly tax return for employers, that deal with qualified wages. You actually break down, based on the criteria I just mentioned, the dollar amount of qualified wages that you would be allowed to use to calculate your tax credit. So you need to make sure that those 941s were done with that in mind, and make sure that the qualified wages lines are filled out properly. If not, go back and amend, talk to your accountant if you use one. They can certainly help you amend. I'm sure they're getting a lot of requests for this now. As far as how to claim the tax, actually claim the credit goes, and how to get paid for it, there was a Form 7200, which is an advance payment of the tax credit. Like I mentioned, this can be an advance tax credit. It would have had to have been filed by February 1st for the 2020 quarters. I believe that's Monday. It's probably not happening for the majority of people on this conference. So what you do to claim the credit then is you simply claim it when you file your annual return each year, whatever that return looks like, whether that's a 1065, an 1120, 1120S, or your personal return, Schedule C for sole proprietorships and disregarded entities. Whatever your return looks like, you'd simply claim the credit on that return to get it retroactively. And then as far as the 2021 quarters go, because like I said, Congress extended this credit through June of 2021 and may extend it further, you might look at using the Form 7200 for any tax credits you might be able to claim in 2021. Once you file the Form 941, you'd be able to use the 7200 to claim the credit and actually get the government to pay you that money back. Now, before you can get the advance credit, what you need to do is withhold as much as you can from employer side payroll taxes, specifically Social Security taxes. Medicare is not eligible. You still have to pay the Medicare taxes to the government, but the Social Security taxes, you can withhold the amount of employer side taxes you'd normally pay and apply that as part of the credit that you're claiming. It's balancing act and netting act, because once you do that, you could use the 7200 for the difference, because you're not going to get the full value of the credit in your Social Security withholdings. So 7200 is good to claim the advanced amount. One pitfall to avoid: do not hold back the employee withholdings. Anything that you withhold from employee paychecks, Social Security, Medicare, income taxes, still needs to get remitted to the IRS. That hasn't changed. Golden rule, speak to your accountant because everyone's situation is different, and a good accountant is worth their weight in gold. Honestly, they can help you navigate the complexities of this and get what you're entitled to in tax credits, make sure your forms are done properly, and make sure you're getting the money as quickly and efficiently as possible. So talk to your accountant. So like I said, it was supposed to expire end of 2020, but it was extended in the Consolidated Appropriations Act and the COVID relief portion. It's no longer mutually exclusive, but there's a big kicker when I say they're no longer mutually exclusive. You can get a PPP loan and this employee retention tax credit, but you can't double dip or triple dip depending on your perspective. So if you are using the PPP loan to pay an employee's wages or salary, you cannot then claim an employee retention tax credit against the same wages that are paid with the PPP loan proceeds. They're not qualified wages. Qualified wages could include any wages that are not paid for out of PPP loan proceeds. So if you for one thing, if you're paying wages in excess of what the PPP loans are covering, those wages could be qualified wages. Also, if you are strategically using your PPP loan proceeds to pay the required amount of wages, but then paying, using the rest of those proceeds for other covered expenses like overhead, things like that, then, if you're balancing your use of the PPP loan proceeds, the wages above what's covered by those proceeds could then be qualified wages. It's a balancing act, but if you do it strategically, you may be eligible for at least some of this employee retention tax credit, if not all of it. Again, it's another thing to talk to your accountant about because the numbers are important. You want to make sure that you're looking at this strategically to maximize your return on both COVID relief funds. Like I said, it's double dipping that they're trying to prevent, or possibly triple dipping, depending on your perspective, since one other kicker with this latest COVID Relief Act is that the payroll expenses that you pay with the PPP loan proceeds are now deductible as ordinary necessary business expenses from your taxes. So that right there is the IRS considered that double dipping. That's why they were trying to prevent that in the first place. But Congress said, no, we want to allow this. We want to maximize people's relief. So that sort of thing is permissible now. But then stacking the ERTC on top of that with the same funds is just a bridge too far. Some frequently asked questions that I've gotten about this ERTC: do seasonal employees qualify because you're only bringing them on for set periods of time? The answer is yes, especially since, year over year, which is the measurement, you look at your eligibility based on your income in 2019 versus 2020 or 2021 now. Seasonal employees would have factored into that in all, in 2019, just as they would in 2020. The wages, the way of calculating advance payments for seasonal employees is a little different. Again, talk to your accountant, but the wages should qualify. As I said, use the Form 941 to report the eligible qualified wages before trying to claim the tax credit. That's how you normally do that. And this is the big one that I've been asked almost, 2 or 3 times a week for the last few weeks now. What are we expecting to change with the new stimulus plan that's currently on the table? We're really not sure. We're still digesting what we've heard of it. We've gotten some broad brushstrokes explanations of what they're looking for, but obviously, and you can see this in the news every day, the next stimulus bill is an open negotiation. We really don't know what the size or scope of it will be. I don't expect that the ERTC is going to get much change. Maybe they extend it through Q3 or Q4 of this year, but it's just not that popular a relief mechanism compared to the PPP loans. It's, it gets some attention still, but I'm not expecting some radical changes to it. But who knows? We'll see. Reach out to me when the next relief bill passes, and I'll let you know what's in it. So a few closing notes on the ERTC before I get to the Q&As. You know, it is important to understand that these COVID relief bills were pretty hastily written. Some of them were written overnight by House and Senate aides. A lot of the House and Senate members hadn't even read them before voting on them. So there's some, when you actually go back and look at them, there's some obvious problems. There's some provisions of the relief bills that straight up contradict each other. And so they lend themselves to some interpretive, some interpretation by the rule makers, by the IRS, by you name it. And so we're working with guidance that's still coming out from the IRS. A lot of the guidance on their website right now is largely inaccurate because it hasn't been updated to account for the December relief bill, which changed a lot of the eligibility criteria for the ERTC. So be wary when you're looking at the IRS guidance page. I normally recommend, go to the source, go to the IRS, see what it is they have to say on it. But unless you see that they have updated that page in January or later, it's out of date by this point and probably wrong. So keep looking, but make sure you look at those updates, the lines that say updated on, because that matters. Let's see here. Let me open up the Q&A now and see what we've got. I see we've got at least one. Does a restaurant that was required to close but was able still to do takeout or small outside dining meet the requirements to qualify for the ERTC? The answer is not necessarily based on the criteria that the restaurant was forced to shut down, because it wasn't a complete shutdown necessarily, though if I remember correctly, there may have been some periods in some areas where restaurants were forced to shut down briefly. But by and large, restaurants that were able to stay open in some capacity aren't considered shut down under the strict language of the ERTC. But most of the restaurant clients I have talked to have had at least a 25% decline year over year between 2019 and 2020. Especially with the loss of indoor dining and in some cases outdoor dining if their spaces just didn't meet the requirements to open. So, you might not be eligible under one metric, but you'd probably be eligible under another. So it's worth looking at those numbers and seeing, did I have a 25% revenue decline year over year?
And Ian, I wanted to get back to Sally's question regarding partnerships and the different types of income. I did some research while you were talking, not because I wasn't paying attention to you, but I've already heard it before a couple of times. But Sally, so with partnerships, I've been able to find some language regarding the box 14 self-employment income, not about box 2 net rental real estate earnings. If you had box 14 self-employment income, the rules are showing that you could not apply for PPP as individuals. Instead, you'd have to consolidate and do that under the LLC. So
I would add, now that the coffee is setting in and I've had a time to mull that over a little bit, passive rental income isn't typically considered business income in some contexts when you're talking about certain government relief programs and tax credits. So it may well be that for purposes of the PPP loan, it simply doesn't qualify. It's worth looking into a little bit more, but the sort of passive rental income we're talking about that would, if you owned a rental property individually, would just be Schedule E passive income. It simply may not qualify for purposes of PPP. It's worth looking into.
yeah, and I think the final answer there is, at least from our standpoint, that would make sense for you to hire a CPA and do a deep dive into the SBA interim findings and information, see if they have any comments on that. Otherwise, maybe the statute. And I'm sorry, we're not able to give you a better answer than that. There's just so much information out there, but it would be worth looking into and seeing if that applies at all. But it sounds like you probably are going to be able to apply for PPP as individuals, although I sense that net to income is not going to be a factor. on employment expenses, but you need to verify that. Think we got another question?
Okay, so we've got a question. I'm with private school. We were sent home by state order. We continue to provide remote learning. Do we qualify for ERTC? We asked for PPP loan forgiveness. How would we access the benefits of the ERTC if we do qualify? Great questions. So again, your business wasn't shut down completely by the public health order. You transitioned to remote learning. That's my understanding. Maybe you were shut down for some brief period of time, which may qualify you for at least a quarter. But the question, if you don't qualify because you weren't fully shut down, the question then becomes, did you experience a significant drop in revenue otherwise? If your answer is yes to either of those questions, if you fully shut down for a period of time where you experienced a significant drop in revenue, you should qualify for at least a quarter, if not, well, really you should qualify for at least 2 quarters at that point because of the buffer quarter. So then the question becomes, how do you access the benefits? What you would do, like I said, just go back, look at your payroll return, your quarterly payroll returns, the Form 941. Make sure that the lines having to do with qualified wages are filled in. A lot of people ignored those lines because they hadn't seen them before. They were an addition in 2020 for this tax credit. So make sure those lines are filled in. If they are, make sure they're accurate as well. If they are, then, like I said, at this point for 2020, to claim the credit retroactively, you would just do it on your annual return at this point. And then for 2021 going forward, make sure you're still doing the 941s and marking the eligible wages, and then use the Form 7200 to claim the advance credit and ask the IRS to pay you that. Like I said, withhold going forward the amounts from employer side payroll taxes that you're allowed to withhold, and then you use Form 7200 for the difference.
Okay. And I can open up if anyone wants to raise their hand and ask a question. Would you guys like to wait for just a minute? Let's see if anybody would like to ask a question.
Looks like one came through the chat.
Okay.
Great.
Okay.
It's actually a chat from me, from Adrian Gallegos, to the panelists.
Okay. Is my company eligible? As of December 2020, employers with 500 or fewer employees are able to claim if they have specific revenue deduction. 2020, specifically businesses that experience a decline, gross receipts by more than 20% in any quarter. Okay. I guess I'm not understanding the question. Is my company eligible?
It's not a question, Ian. I was giving you some, you had a question from somebody that asked if they were shut down, were they still eligible for the employee tax retention, right?
Right.
So you have to really keep in mind too that it depends on your gross receipts any quarter of 2019. And I wasn't sure if that got relayed, so I just sent you a little boost in your
No,
answer
much appreciated. And I do want to clarify, if I didn't already make it clear, this is an either or test. You don't have to have been shut down and have a decline in revenue. Either or. If you were shut down for some period of time but somehow didn't have a decline in revenue, then you might still be eligible. That's not the case for anyone, but even if you weren't fully shut down due to a public health order, if you had a significant decline in revenue as compared to 2019, you should be able to claim that tax credit. But keep in mind, it is evaluated on a quarterly basis as compared to 2019.
Any other questions?
do not see any other questions that have come in. I do want to remind everyone that we do have some other webinars coming up. We have cybersecurity next week, Tuesday and Thursday, part 5 and 6. We also have basic steps to starting a business in New Mexico on Wednesday the 3rd from 11:30 to 1. And then February 8th, we will have from bricks to clicks coming up at 11 a.m. We also look forward to hearing more information about this topic, because I know I have seen this presentation before and I'm getting new information every time. So I'm hoping that we can continue getting the information out to the public whenever there's new changes and stuff happening, and then just kind of looking at it again and keeping up with the information. So
Sorry to interrupt. We do have one more question.
great, sounds good.
Do the quarters have to be standard quarters? Like, can you evaluate June through August, for example? And the answer is the quarters have to line up with your actual payroll tax quarters. So if you do your, the quarters can vary depending on your tax year election somewhat, but by and large, the quarters still line up with the standard IRS taxable quarters. To answer your question, you can't use non-standard quarters. You can't, for example, evaluate based on 3 months of your choosing. They would typically line up with the quarters in which you report wages for payroll tax purposes. Does that make sense? Like if you're doing your 941 for January through March, you would need to use that quarter in measuring your eligibility for the ERTC. We got another question. Where should a business look to find a good CPA? Many rural CPAs are not accepting new clients. That's a great question, and I know that this is a struggle for a lot of folks out in different parts of New Mexico. My recommendation there would be, if you can't find a rural CPA accepting new clients, reach out into one of the larger population centers. Some of the larger firms here in Albuquerque, for example, can service rural clients. You may have to drive in for some reason, though a lot of CPA firms are onboarding new clients through Zoom, through GoToMeeting, things like that, where you can scan and email documents or mail them or fax them depending on your comfort level. So if you can't find a rural CPA, you may have to go with one of the larger firms here in Albuquerque or Santa Fe or Las Cruces.
And I'll tell you, I know there's at least one CPA. I'll throw it out right now, Fred Muhlemeyer. He's located in Albuquerque. And so if you don't mind doing business over the phone and the internet, he's a really good guy, really good resource to reach out to. He's got a small firm, I think of 2 or 3 CPAs. So it's not a large firm either, but I know he does have capacity and he's taking on new clients. Any other questions?
Oh, time is it? It is, we've got just a few minutes. There is one point I didn't mention that I just realized it just came up. In 2021, like I said, Congress extended the ERTC through June. They also increased the amounts. So whereas in 2020, the amount was 50% of up to $10,000 in eligible wages per quarter, the amount is now 50% of up to $14,000 in eligible wages per quarter, which means that the tax credit is effectively $7,000 per quarter per employee versus the $5,000 that you would have been eligible for any quarter in 2020. So the amounts have gone up, which just adds a little more incentive to start claiming that, especially now that we're well outside of the covered periods for PPP loans, unless you're taking a second draw. Okay, well, there's no other questions. I think I can hand this.
And we've got just a comment here that I'm sure you guys saw in the chat that said, wonderful presentation. Thank you everyone for your time and expertise. It is much appreciated. So on that note, want to thank you for today's presentation. And yeah, if there are no questions, we can go ahead and wrap this up.